You want to know the single most important thing in the stock market? Here it is. Know what you own. That's it. Sounds too simple, right? But it's the one rule most people ignore, and it's exactly why they lose money. I can't tell you how many times I've asked investors, why do you own that stock? And you know what they say? Well, it's going up. Beautiful. That's like saying, I bought a donut because it looks delicious. Sure, but that doesn't mean it's good for you. Most people don't own businesses. They own symbols, little ticker codes flashing on a screen. They have no idea what's behind them. No clue what the company does, how it makes money, or who its customers are. If you pressed them to explain it in plain English, they couldn't do it in 2 minutes. And if you can't explain to a 10-year-old why you own a stock, you shouldn't own it. That's my rule. Let me tell you something funny. I once gave a talk, and I described the kind of company most people love to own. It made a 1 megabit SRAM CMOS bipolar risk floating point data I divided by O array processor with a 6 gigahertz double metallization asynchronous communication protocol. And everyone in the room nodded like it was genius. Of course, I was making it all up, because that's what people fall for. The jargon, the complexity. It sounds smart. It feels like the future. But it's really a trap. People think that if something is complicated, it must be valuable. That's not investing. That's insecurity. They're trying to buy genius in a bottle. Some of the best investments of my career came from the simplest businesses imaginable. You know, one of my favorite examples, waste management. Yes, trash. Literal garbage. While most investors were chasing high-tech dreams, I was looking at companies hauling away banana peels and old tires. And you know what? They made a fortune doing it. When I first looked at waste management, it wasn't glamorous. Nobody on Wall Street cared about garbage trucks. Analysts weren't writing glowing reports about landfills. But what I saw was an industry that was incredibly fragmented. Thousands of small, family-run companies picking up trash in their own towns. That's not fast growth, but it's steady, predictable, cash-producing business. And I thought, what if one company starts buying all those little guys and doing it better? That's exactly what waste management did. They rolled up the industry, improved operations, and grew like wildfire. By the time I wrote One Up on Wall Street in 1989, waste management had already gone up about 100-fold from when I first invested. 100 times your money from trash. Not microchips, not biotech, trash. Now here's the point. You didn't need to be a genius to understand waste management. You didn't need to decode technical reports or run Monte Carlo simulations. You just needed common sense. The company charged cities to pick up garbage, buried it, and made a profit. That's it. No secrets, no Wall Street magic. If you had walked down your street on a Tuesday morning, watched the garbage truck stop in front of every house, and realized they were getting paid for it, you already understood the business model. That's how I invest. Not with theories, not with predictions, but with observation and understanding. You can learn more from walking into a store than from reading 20 analyst reports. You can spot a winning business by noticing what ordinary people use and pay for every day. When I ran the Fidelity Magellan Fund, I wasn't looking for fancy. I was looking for familiar companies that made sense, that had a story you could tell in one paragraph, not a PhD thesis. That's why I always tell people, invest in what you know and know what you own. They sound like the same thing, but they're not. Invest in what you know means start with your circle of competence businesses you see, use, and understand. Know what you own means go deeper. Understand why it's a good business, how it earns money, what could hurt it, and what could help it grow. If your only reason for owning a stock is that someone on TV said it's a buy, congratulations, you're speculating, not investing. People often forget a stock isn't just a number bouncing up and down. It's a slice of a company, and a company is a living, breathing thing with employees, products, customers, and problems. If you understand that company, if you truly know it, then you'll also understand what to do when the stock drops. You'll have the conviction to hold or the clarity to sell because you won't be reacting to noise. You'll be reacting to facts. That's the difference between investors and gamblers. Gamblers react to prices. Investors react to businesses. So if you take only one thing from me, take this. Don't try to sound smart. Try to be informed. Don't try to predict what the market will do next week. Try to understand what your company will do next decade. And please, for your own sanity, if you can't explain your stock to a 10-year-old in 2 minutes, sell it and move on. Because the moment you understand what you own, you stop gambling and start investing. That's where everything changes. You don't need Wall Street's permission. You don't need an economics degree. You just need common sense. And common sense, my friend, beats complicated nonsense every single time. You know what amazes me most about Wall Street? Everybody's trying to look smarter than the next guy. They'll build a 20-page spreadsheet, run a discounted cash flow model with 14 decimal places, and call it precision. And I'll ask, so what does the company actually do? Then they look at me like I just insulted their mother. The truth is, people confuse complexity with intelligence. They think the harder something is to understand, the more valuable it must be. But investing doesn't reward the smartest guy in the room. It rewards the one who understands what's really happening. When I ran the Magellan Fund, I didn't need to be a genius. I just had to be curious and willing to use a little common sense. Let me tell you something I learned early. Boring companies often make exciting returns. I call it the boring is beautiful rule. When a company sounds dull, when its business could put you to sleep, that's usually a good sign. Why? Because nobody else is paying attention. Wall Street hates boring. They want excitement, glamour, the next revolutionary technology. They want a story to brag about at cocktail parties. But me, I'll take a company that sells paint, cleans hotels, or fixes air conditioners any day. Because those businesses might not make headlines, but they make profits. Let me give you a few examples. I once invested in Taco Bell. At the time, it wasn't exactly high tech. They sold tacos. And most investors thought, who cares about tacos? But I looked around and saw people lined up out the door, day after day, paying for cheap, consistent food. It didn't require a PhD in finance to see that scaling that model across America could be huge. And it was. Taco Bell turned out to be a 10-bagger. That's a tenfold return. Another one was La Quinta Inns, a chain of mid-priced hotels. No glamour, no buzzwords, just clean rooms and good margins. While everyone chased the next Hilton, La Quinta quietly doubled, then tripled. And then there was Dunkin' Donuts. People thought it was a joke, just coffee and donuts. Well, Americans seemed to like coffee and donuts a lot. Dunkin' became a steady compounder. You see the pattern? Sample business, clear demand, repeatable model. That's what wins. Meanwhile, the smart money was busy losing fortunes on high-tech wonders they barely understood. One quarter, it was semiconductors. Next, it was biotech. Then it was something called artificial intelligence, and that was back in 1987. Different buzzwords, same story. The problem with smart companies is that the future is already priced in. Everyone expects miracles, and when perfection doesn't show up, the stock crashes. But boring companies, they're underestimated. Nobody expects much so when they just keep making money. Investors are pleasantly surprised. And that's when the big returns happen. When I talk about simple businesses, people sometimes roll their eyes. They say, come on, Peter, how can you beat the market buying coffee shops and garbage collectors? And I tell them, exactly because they're coffee shops and garbage collectors. You don't need insider data or complex algorithms. You just need to observe life. Walk into a mall. Which stores are full? Walk down your street. Which brands do people actually use? Open your fridge. What products do you keep buying month after month? Those are clues. Real clues from the real world. That's the secret. Use what you already know. Now, don't mistake simple for easy. You still have to do your homework. You still have to look at the numbers. But you don't need to overcomplicate it. When I find a company I like, I ask 5 basic questions. 1, is the business understandable? 2, is it profitable and growing? 3, does it have a repeatable model? 4, can it expand without destroying what works? 5, and most important, would I still be happy to own it if the market closed for 5 years? If I can answer yes to all 5, I'm interested. If not, I move on. Simple. You see, investing is not an IQ test. If it were, half of Wall Street would be rich and happy, and they're neither. It's a patience test. It's about staying rational when others lose their minds. It's about focusing on what you can understand and ignoring what you can't. I've met people with perfect academic records who were terrible investors. They could quote Keynes and Friedman, but couldn't explain how a grocery store makes money. They were so busy trying to outsmart the market that they forgot to understand it. Here's the irony. Ordinary people actually have an edge. You shop, you eat, you live in the real world. You notice trends long before analysts do. By the time a Wall Street report mentions a company like Starbucks, your neighborhood already has 3 of them. So when you find a business that's simple, familiar, and growing, don't ignore it just because it's not glamorous. That's often where the gold is buried. The market rewards results, not buzzwords, and profits, not PowerPoint slides. When I look back at my years running the Magellan Fund from 1977 to 1990, the best winners all shared the same DNA. They were easy to understand, profitable, and overlooked. That's it. No rocket science, no equations from outer space, just plain logic. So here's my advice. Stop chasing what's complex. Start mastering what's simple, because in this business, simple beats smart. Every single time. You know, there are 2 kinds of investors in this world. The first group hunts for cheap. The second hunts for good. I've tried both, and trust me, good beats cheap every time. Early in my career, I thought like a bargain shopper. I loved stocks that had fallen from $20 to $3. They look like steals. Then I learned the hard way some stocks drop for a reason. Sometimes that bargain is just a bad business on its way to zero. So I stopped chasing what looked cheap and started buying what was worth owning. That's the key difference between value and quality. Value investing says, it's down 50%, it must be a deal. Quality investing says, it's a great company, I don't care if it's up 50%. People love to quote Warren Buffett, but few actually follow what he evolved into. He used to buy cigar butts, beaten down companies with one puff left. Later he realized, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's what I discovered too, running the Magellan Fund. So what makes a company wonderful? Forget the fancy definitions. Here's my version. A quality company is one that, 1, makes real money, not accounting illusions. 2, grows consistently, not just when the economy is booming. 3, has a product people actually need and keep buying. 4, earns high returns on what it invests. 5, and this is the big one, has an edge. That edge could be a brand, a network, a patent, or simply doing something better than everyone else. I call it a sustainable competitive advantage. In plain English, it means the company has a moat around it, so competitors can't steal the castle. Take Coca-Cola, for example. You can start a new soda company tomorrow. You can make it cheaper, sweeter, healthier, good luck, convincing billions of people to stop drinking Coke. That's brand power, and brand power shows up in the numbers. Look at Coke's gross margin, roughly 60%. That means for every dollar they sell, 40 cents goes to costs, 60 cents stays before expenses. That's extraordinary. You don't get margins like that unless you've built something competitors can't copy. Here's a simple test. If a company can raise prices without losing customers, you've found a moat. Coke passes that test. So does Apple. So does McDonald's. So did every long-term winner I ever owned. Now, let's talk about the opposite companies that pretend to be high quality. They love to talk about growth opportunities, synergies, and restructuring. But if you check the basics, they're not making real profits. They dilute shareholders. They issue debt to pay dividends. They confuse activity with productivity. A company's annual report should read like a love letter to common sense. If it reads like a legal contract run, when I look at a stock, I don't start with the price. I start with the business, because over time, the business drives the stock, not the other way around. When I owned Dunkin' Donuts, I didn't care about what the market said week to week. I looked at one number, earnings per share. If that kept growing year after year, the stock would follow. Maybe not next Tuesday, but eventually. That's another trait of quality companies. They compound. They reinvest profits wisely. They don't need miracles. They just need time. Now, people always ask, Peter, how do I know if a company is truly high quality? Here's my quick checklist. Asterisk, strong balance sheet, little debt, lots of cash. Asterisk. High return on equity. They use capital efficiently. Asterisk, stable profit margins, no wild swings. Asterisk. Repeat customers, not one-time hype. Competent management, new empire builders. If you want to test the last one, listen to how the CEO talks. Do they speak clearly or hide behind jargon? Do they focus on reality or on market share growth initiatives? Nobody understands? A great CEO sounds like a teacher, not a politician. Let me tell you something else. High quality doesn't mean expensive. It means durable. A mediocre company might look cheap today, but it's cheap for a reason. A great company might look pricey, but 5 years from now, it could be a bargain in hindsight. People worry too much about price tags and not enough about value creation. If a company grows earnings 20% a year, the stock will eventually catch up, even if you didn't buy it at the perfect moment. That's why I never lose sleep over paying a fair price for a great business. Because time compounds quality faster than you think. You don't have to reinvent the wheel. Most of the great businesses share the same DNA. They make something simple, sell it globally, and do it better than anyone else. McDonald's sells burgers. Coca-Cola sells sugar water. But they sell them efficiently, predictably, and profitably year after year after year. That's what separates great stocks from temporary stories. When I started investing, I used to chase every shiny idea that came along. Then I realized the winners were usually hiding in plain sight. The trick wasn't to find something new, it was to recognize something enduring. So here's my advice. Stop hunting for bargains. Start looking for quality, because bargains fade, quality compounds. In the long run, markets reward strength, not cleverness. And strength comes from one thing, owning companies that can take a punch and keep compounding. If you find one of those, hold on tight. You won't need many. Just a few great businesses held long enough can make your lifetime. You know what everyone loves to talk about? The economy, interest rates, inflation, unemployment. oil prices, recessions, elections. They never stop. Turn on CNBC for 5 minutes, and you'll hear 12 different people telling you 12 different predictions, and all of them sound confident. You'd think they had a crystal ball. They don't. And here's the truth. None of it matters. I've been saying this for decades. If you spend 13 minutes a year on economics, you've wasted 10. And I mean it. I can't tell you how much time investors waste trying to forecast the economy. They buy when they think there's a soft landing, sell when someone whispers recession, and miss the entire point of investing. When I ran the Magellan Fund, I didn't make one dime predicting the economy. Not one. I made money finding good companies. Because over time, companies grow, economies fluctuate. Let me take you back to the early 1980s. It was chaos. Prime interest rate at 20%, inflation in double digits, unemployment high. Every economist was gloomy, and yet that was the start of one of the greatest bull markets in history. Not one expert predicted it. In 1982, nobody said, hey, we're about to enter a decade of prosperity. They were too busy panicking about the stagflation crisis. And meanwhile, the smart investors were quietly buying solid companies while everyone else was hiding in the basement. That's when I realized something. The economy and the stock market are two very different animals. Think about it. If the economy and the stock market always moved together, then when unemployment rose, stocks should fall. But history doesn't agree. Stocks often bottom before the economy recovers. Because markets don't care about what's happening, they care about what's coming. And nobody, I repeat, nobody can predict that consistently. So why waste your life guessing the unknowable? Focus on what's knowable. How good is this company? Can it survive tough times? Will people still buy its products if interest rates go up? Those questions matter. The rest is noise. Let me show you with a real example. Waste management. In 1995, the company earned 55 cents a share. By 2023, it earned $5.69 a share. That's roughly a tenfold increase in earnings. And guess what the stock did? It went from about $18 to $179, almost exactly 10 times higher. Now, between those 2 points, do you know what happened? Multiple recessions, oil shocks, housing bubbles, financial crisis, a pandemic, yet waste management just kept collecting garbage quarter after quarter, making more money. The macro didn't matter. The business did. Every time there's a headline screaming recession coming, I get the same question. Peter, should I sell my stocks? I always say, which ones? If you own great businesses, why sell them because someone on TV is nervous? If you own bad ones, why wait for a recession to find out they're bad? Either way, the macro doesn't change the truth about your companies. It only changes how the crowd feels about them. And that's an opportunity, not a threat. You see, markets move like moods. They swing from euphoria to depression and back again. But businesses, they move by execution. When I invest, I'm not asking, will GDP grow 2% or 3%? I'm asking, can this company grow earnings 15% for the next 10 years? Because over a long enough period, earnings drive prices. If you follow that one relationship between business results and stock performance, you'll understand 90% of the market, the other 10% is just noise. I've met so many smart people who failed as investors because they couldn't stop trying to predict the macro. They'd say things like, I'm waiting for a pullback, or rates are too high. 5 years later, the stock they waited on had doubled, and they were still waiting. Timing the market is like trying to time your next heart attack. Good luck with that. The best investors aren't fortune tellers. They're patient observers. They pick great businesses, ignore the noise, and let time do the compounding. I'll give you another perspective. When you buy a house, do you sell it because mortgage rates go up 1%? No. You live in it. You use it. You understand it. You're investing for the long haul. But when it comes to stocks, people lose their minds. One bad inflation report and they sell the company they believed in last week. That's not investing, that's panic management. I once said, in the long run, the stock market is a story of companies. Not headlines, not politics, not the Fed, companies. If you focus on understanding those stories, what they make, how they grow, and why customers love them, you'll do just fine. But if you spend your days watching economists argue, you'll end up smarter about theory and poorer in practice. So here's my advice. When the next pundit says the economy's headed for disaster, just nod politely. Then go back to studying your companies. Because while they're trying to predict the wind, you'll be busy building sails. And that's how you get ahead. Remember, macroeconomics is entertainment. Earnings are education. The future doesn't belong to the best forecaster. It belongs to the most patient owner. Ignore the macro. Focus on the micro. That's where the money is. People ask me all the time, Peter, what's the secret to your success? They expect me to say something fancy like advanced analytics or insider tips. But the truth is boring. The real secret is time. You don't need perfect timing. You need time in the market. That's the only advantage ordinary investors have over the professionals. They can sit still. When I ran the Magellan Fund, people were in a constant hurry. They'd call their brokers out of breath. Peter, is it too late to buy? Should I sell before earnings? Should I take profits now? It always amazed me. Everyone acted like the stock market was a subway. If they missed one train, they'd never get another. Relax. The market's not going anywhere. You have plenty of time. Let me give you an example. I love to tell Walmart. The company went public in October of 1970. It already had a solid track record, 15 years of growth, strong management, and a clear business model. Now, imagine you were a cautious investor. You thought, I'm not sure yet. Let's wait and see. So you waited 10 years until 1980. Guess what? You still made 35 times your money. That's right. Even if you waited a full decade after the IPO, you could have turned $10,000 into $350,000. If you had bought at the IPO and held through, you'd have made 500 times your money. But my point is, you didn't have to be early. You just had to be patient. That's the beauty of time. It forgives hesitation, but it punishes impatience. Here's another one. Microsoft. It went public in 1986. Now, I know nothing about software. I still struggle to set the time on my microwave. But if you knew something about technology back then, it was obvious these guys were onto something. Even if you waited 3 years after the IPO to buy, you still made 10 times your money. 3 years late, tenfold return. Time rewards understanding, not speed. The problem is, most people think the stock market is a race. They want instant results, instant profits, instant everything. But that's not how compounding works. Compounding is slow, painfully slow, until it's suddenly unstoppable. Think about a tree. For years, it looks small, barely growing. Then one day, it shades the whole yard. That's how wealth grows invisibly, then all at once. I'll tell you something I've seen over and over. The investors who lose are the ones who keep selling their winners too early. They say, well, I've doubled my money time to take profits, and then they hold on to their losers, hoping they'll come back. That's like cutting the flowers and watering the weeds. It makes no sense. If a business is thriving, why sell it? If it's dying, why keep it? Let your flowers bloom. Pull out the weeds. It's not complicated, it's just human psychology. People can't stand seeing volatility. They think if something goes down 10%, it's the end of the world. But volatility is the price you pay for growth. No volatility, no returns. The best thing you can do for your portfolio is sit on your hands. When you own a great company, time is your best ally. Every year it grows earnings, expands its moat, pays dividends, reinvests profits, all while you do absolutely nothing. That's my kind of work, the kind where you make money while taking a nap. Now, I know patience sounds easy but feels hard, especially when the market drops. In 1987, the market fell over 20% in a single day. It was chaos. People panicked, but I didn't sell. Why? Because I knew what I owned. The companies were still strong. Their businesses didn't disappear, only the prices did. A few years later, those same stocks were hitting new highs. The people who sold lost. The ones who held got rich. That's the power of time. It turns fear into fortune if you let it. Most people underestimate what 10 years can do. They overestimate what 1 year can. That's why the average investor's return is lower than the market itself. They keep jumping in and out, chasing performance instead of compounding. If you'd simply held an index fund for 20 years, you'd have beaten most professionals and saved yourself a lot of stress. Imagine what happens when you own not just the index, but the best individual businesses. That's how you win big. Here's the thing. The market rewards owners, not traders. You don't get rich by predicting what happens next month. You get rich by letting great businesses work for you for years. It's not about when you buy. It's about how long you hold. Because the longer you hold something good, the more the math starts working in your favor. Einstein supposedly called compound interest the eighth wonder of the world. He was right, though. I doubt he ever owned a mutual fund. Time multiplies quality. If you own a lousy company, time will reveal it. If you own a great one, time will reward it. So when you feel that urge to sell because you're bored, scared, or impatient, remember this. The market's greatest weapon is volatility. Your greatest weapon is patience. One of them works against you. The other saves you. Let the professionals chase headlines and quarterly forecasts. You focus on holding businesses that can survive and thrive for decades. Because in the end, the winners aren't the fastest traders. They're the calmest holders. And the calmest holders are the richest. Everywhere I go, people want to talk about the economy. They'll grab my sleeve and say, Peter, what do you think about inflation? Or, where are interest rates headed? Or my favorite, are we going into a recession? And I always tell them the same thing. If you spend 13 minutes a year on economics, you've wasted 10. I'm not joking. I've been in this business for decades, and I can promise you, nobody, not me, not the geniuses on Wall Street, not the talking heads on TV, can predict the economy with any consistency. But that doesn't stop people from trying, and it sure doesn't stop them from losing money while they do it. I remember the early 1980s like it was yesterday. The prime rate was 20%. Unemployment was in double digits. Inflation was eating people's savings alive. The newspapers were screaming, "Economic collapse," in big, bold letters. And you know what happened next? We had one of the greatest bull markets in history. Not one economist I knew predicted that. Not one. Because they were too busy counting clouds to notice the blue sky forming underneath. That's when I learned a lesson I never forgot. It's useless to predict the macro because the world is too complicated and the economy doesn't move in straight lines. It stumbles, it recovers, it surprises you. But great companies, they keep making money anyway. When I ran the Fidelity Magellan Fund, I didn't waste my time guessing GDP numbers or inflation targets. I studied businesses. I looked for firms that could grow earnings year after year through recessions, wars, oil shocks, and presidential elections. Because at the end of the day, stocks follow earnings, not headlines. Let me show you what I mean. Take Waste Management, one of my favorite examples. In 1995, their earnings per share were 55 cents. By 2023, they had grown to $5.69 per share. That's roughly 10 times higher. And what did the stock do during that period? It went from $18.88 to about $179. Also roughly 10 times higher. Now, between 1995 and 2023, what happened? We had the dot-com bubble, the housing crash, the Great Recession, a global pandemic, multiple wars, oil price shocks, you name it. And yet, the business just kept collecting garbage, hauling it away, and billing its customers. Because that's what great companies do. They adapt, they endure, and they compound. The stock market is a story of companies, not economies. But people don't want to hear that. They'd rather talk about the Fed or the next election because it feels like control. It gives them the illusion that they can forecast the future. But here's the truth. If you can't predict the weather next month, what makes you think you can predict the economy next year? I've met countless investors who missed out on incredible gains because they were waiting for the right economic conditions. They said, "I'll buy when the recession ends." Well, by the time it ends, stocks are already 50% higher. The market doesn't wait for you to feel comfortable. In 1982, people were terrified. But that's when you should have been buying. In 2008, it was the same story, panic everywhere. And the people who held strong or even added to their positions made fortunes in the decade that followed. The best buying opportunities always feel the worst when you're living through them. Let me tell you what I actually focus on. Not inflation, not interest rates, not GDP. I focus on the micro, the individual business. When the economy slows, does this company still make money? Can it raise prices without losing customers? Does it have recurring demand? Does it have low debt and strong cash flow? If the answer is yes, then who cares what the economists say? Because even if there's a recession, people will still buy toothpaste, soda, and garbage collection. They'll still eat at restaurants, fill prescriptions, and shop for clothes. The economy might shrink, but life doesn't stop. And neither do good businesses. Investors get scared because they forget what a stock really is. It's not a number that moves up and down on your screen. It's a share of a company. And that company is run by real people who wake up every morning trying to make more money than yesterday. They don't check the GDP before opening their factories. They don't ask the Fed what the interest rate is before baking bread. They just work, sell, and earn. And over time, that effort shows up in the stock price. It's that simple. So the next time someone tells you we're heading into a recession, ask them, which one? The one the market already priced in, or the one that never arrives? Don't build your portfolio around guesses. Build it around facts, profits, cash flow, customers, and competitive advantages. Those things you can actually understand. The macro is entertainment. The micro is education. If you want to predict anything, predict this. Over the next 20 years, good businesses will keep growing, bad businesses will keep failing, and the people who ignore the noise will end up a lot richer than the ones who try to outsmart the news cycle. That's how I did it. Not by predicting the future, but by staying focused on the present. The economy will always go up and down. That's its job. Your job is to ignore it, stay invested, and let your companies work for you. Because in the long run, markets don't reward the smartest forecasts, they reward the calmest convictions. If there's one force in investing that beats intelligence, timing, and luck combined, it's time. Time is the real genius in this business. But the problem is, nobody wants to give it a chance. Everybody's in a hurry. They want double-digit returns by next Tuesday. They think patience means holding a stock for 3 months instead of 3 minutes. That's not patience, that's delayed panic. When I ran the Fidelity Magellan Fund, I used to get calls from investors gasping for breath. Peter, should I buy now? Is it too late? Should I take profits? They sounded like they were chasing a bus. Relax, I'd say. The market isn't going anywhere. You have plenty of time. The real money isn't made in the buying or the selling. It's made in the waiting. Because time, not timing, does the heavy lifting. Let me prove it to you with a name you know. Walmart. The company went public in October of 1970. It already had 15 years of consistent growth and a strong balance sheet. Now, suppose you didn't jump in right away. You thought, I'll wait. Let's see how it does. So you waited 10 years. You finally bought Walmart in 1980. Guess what? You still made 35 times your money. Think about that. You could have waited a decade and you still made 35 times. If you'd bought at the IPO and held on, you'd have made 500 times your money. That's the power of time. It forgives hesitation, but it punishes impatience. Here's another one, Microsoft. They went public in 1986. You could have waited 3 years after the IPO to buy and still made 10 times your money in the following decade. See the pattern? You didn't need to catch the bottom. You didn't need to buy at the perfect time. You just needed to stay put long enough for the company to grow. But that's not how most people behave. Most investors treat the stock market like a casino. They buy when it feels exciting and sell when it feels scary. They want action, not results. They confuse movement with progress. You ask them how long they held the stock, and they'll proudly say, 3 months. That's not investing, that's speed dating. You can't build wealth that way. You build wealth the way you grow trees, slowly, silently, with patience. It takes years for the roots to form before you see any real growth. And if you keep digging it up to check on it, guess what? It dies. One of the dumbest habits I've seen in this business is selling your winners too early. People say, I doubled my money, I'm taking profits. Then they hold on to their losers, praying they'll come back. That's like cutting the flowers and watering the weeds. It's completely backward. If you own a great business, let it grow. Let the earnings compound. Every year that company stays strong, your returns multiply without you lifting a finger. That's the beauty of time. It's the most loyal employee you'll ever have. It works nights, weekends, and holidays. And it never sends you a bill. When I talk about holding for the long term, I don't mean forever. If the business changes for the worse, or if your original reason for owning it disappears, fine, sell it. But don't sell just because the stock price wobbles. Prices swing, businesses build. Over time, one of those trends matters. Hint, it's not the swinging one. I remember the crash of 1987. The market dropped 22% in one day. That's the kind of day you remember. Even your coffee tasted different. People panicked. They called their brokers, ready to dump everything. But I didn't sell, because I knew what I owned. The businesses hadn't changed. The panic would pass, it always does. A few years later, those same companies were worth far more than before. That's what time does. It turns temporary chaos into long-term clarity. Here's something most investors never grasp. The longer you hold, the less your results depend on luck. In 1 year, luck can ruin you. In 5 years, it can shake you. But in 20 years, discipline beats luck every time. That's compounding in action. It's slow, quiet, and invisible until it isn't. Then one day, you wake up and realize your boring stock has grown tenfold just because you had the sense to leave it alone. The math of compounding is ruthless in your favor. A company growing 15% a year doubles earnings roughly every 5 years. That means in 15 years, you've got 8 times the earnings. If the stock tracks those earnings, that's an 8-bagger. And all you had to do was sit still. Meanwhile, your neighbor traded in and out a dozen times and probably lost money, but hey, he felt busy. Busyness is not a strategy. Patience is. The truth is, you don't need to own dozens of stocks or check your portfolio every morning. You just need a handful of good businesses and enough time to let compounding work its quiet magic. Time is like gravity. It works whether you notice or not, but only if you let it. Every time you interrupt compounding by selling too soon or chasing the next shiny thing, you hit the brakes on your own progress. So don't. Just hold. Let time do what time does best. In this business, the best investors aren't the fastest or the smartest. They're the calmest. They understand that wealth is built not in bursts, but in decades. The market rewards endurance, not adrenaline. And the best returns go to those who have the patience to wait for compounding to finish its masterpiece. So if you remember nothing else, remember this. The key to getting rich in the stock market is not brilliance, it's time. Because time turns ordinary companies into extraordinary investments, and ordinary investors into extraordinary success stories. After all these years in the market, I've come to one conclusion. Investing is not a science. It's not physics. It's not rocket engineering. It's common sense wrapped in patience. And yet, people keep trying to make it complicated enough to feel like genius. The truth is, you don't need to be brilliant to make money in stocks. You just need to avoid being stupid for long enough. When I started out, I wasn't born on Wall Street. I didn't come from an Ivy League background. I mowed lawns at a golf course in Massachusetts. That's where I first overheard the members talk about stocks, not theories, just companies. They'd say, that new grocery chain's expanding, or that tire company's doing great business. It stuck with me, because that's what investing really is, owning pieces of businesses that do well, not timing cycles, not forecasting recessions, and just finding companies that make money and holding on. People look at my track record, 29% average annual return for 13 straight years, and they think there must have been some secret formula. There wasn't. It was just observation, homework, and patience. You could have done the same thing. In fact, you still can. The advantage the average investor has over Wall Street is that you live in the real world. You see what products people are buying, what restaurants are crowded, what brands are gaining attention, long before analysts write reports about them. That's your edge, and it's an enormous one. You don't need to sit in an office on the 45th floor to notice trends. You just have to keep your eyes open when you shop for groceries. When I say common sense, I mean exactly that. Don't buy what you don't understand. Don't sell what's working. Don't listen to people who predict the future for a living. They can't even predict lunch. If the story makes sense, if the numbers back it up, if the company keeps earning more every year, that's all you need to know. Wall Street hates simple rules like that because simplicity doesn't sell. They can't charge management fees for common sense. Make it so they give you fancy phrases like strategic asset allocation, quantitative optimization, and risk-adjusted alpha. I call that financial gibberish. All those words can't change the one truth of investing. Over time, stock prices follow earnings. Not interest rates, not pundits, not predictions, earnings. Let me tell you something about the market that people forget. It's not a casino. It's not random. Behind every ticker symbol is a real company. And that company has employees, customers, cash flow, and problems. If you understand that, you'll be fine. If you forget it, you'll be broke. The stock market is like a mirror. It reflects the real economy, but with emotions added. In the short run, it's manic. In the long run, it's rational. The trick is to outlast the mania. Think of the investors who bought companies like Walmart, Microsoft, McDonald's, or Coca-Cola and held them for 20, 30 years. They didn't need inside information. They didn't need perfect timing. They just needed conviction and patience. Meanwhile, others were jumping in and out, trying to predict recessions or chasing the latest fad. Those people worked harder and earned less. That's the great irony of investing. The more you try to control it, the less you gain from it. But the more you trust your process and give it time, the more it rewards you. When I look back, I realize everything that worked for me came down to a few timeless principles, and not one of them required genius. 1. Know what you own. If you can't explain the business to a 10-year-old, don't buy it. 2. Buy quality. A great company at a fair price beats a fair company at a great price. 3. Ignore the macro. Nobody can predict the economy. Study companies, not countries. 4. Be long-term focused. The big money isn't made in the buying or the selling. It's made in the waiting. That's it. 4 ideas that could fit on an index card. And yet, those 4 ideas made me one of the best performing fund managers in history. Not because I was smarter, but because I stayed disciplined when others got distracted. I've seen investors with PhDs lose millions because they couldn't resist complicating the simple. And I've seen small-town teachers and mechanics quietly retire rich because they just kept investing in what they understood and let time do the rest. You don't need a fancy model. You need clarity. You don't need the latest forecast. You need consistency. And you don't need to be the smartest person in the room. You just need to be the one who doesn't panic when the room starts shouting. If I could go back and give my younger self one piece of advice, it'd be this. Don't overthink. Just think clearly. The market is designed to transfer money from the active to the patient, from the emotional to the rational. You get to choose which side you're on. And you make that choice every day, not by predicting prices, but by holding your ground when fear and greed start fighting. I've always said, stocks are not lottery tickets. There's a company behind every stock. If you remember that one sentence, you'll be ahead of 90% of investors. So don't chase noise. Don't worship complexity. And don't forget that common sense, though simple, is rare. In the end, this game doesn't reward the fastest, the boldest, or even the smartest. It rewards the calmest, the ones who think for themselves, stay the course, and let common sense do what common sense always does win. Here's the secret. Most people on Wall Street don't want you to know. You, the ordinary investor, have an edge over the professionals. Yes, you, the teacher, the engineer, the nurse, the small business owner. You have something that the analysts with fancy suits and expensive degrees lost a long time ago: common sense and freedom. Let me explain. Professionals have money, models, and meetings. They've got research teams, quarterly reports, and a boss breathing down their neck. But what they don't have is patience. They're judged by the quarter, not the decade. If a stock dips for 3 months, they get fired. If it doesn't beat consensus earnings, they panic. You, on the other hand, don't have that problem. Nobody's going to fire you for holding a great company through a bad year. You don't have to impress anyone at the morning meeting. Your advantage is that you can think long term, and that's the one thing professionals can't fake. When I ran the Fidelity Magellan Fund, I used to tell people this: you have better information than I do. They thought I was joking, but I was serious. You see, I had to read reports about companies. You live in them. You shop at them. You see which stores are full, which restaurants are packed, which products your kids won't stop begging for. By the time that data reaches Wall Street, it's old news. But you saw it first. That's how I found some of my best investments, not from analysts, but from real life. Let me give you an example. Back in the day, my wife Carolyn came home raving about this new hotel chain called La Quinta Inns. She said the rooms were clean, the prices were fair, and business travelers were everywhere. So I checked the stock. The numbers matched the story. I bought it. It became a multi-bagger. Another time, my daughters dragged me into a store called The Limited. I didn't understand the fashion, but I understood the sales. The place was packed. Same thing. I looked up the company, liked what I saw, and bought the stock. That turned into another 10-bagger. You don't need a Bloomberg terminal to notice those things. You just need eyes open and a little curiosity. That's why I always say, invest in what you know, but people misunderstand that line. It doesn't mean buy your favorite brand of ice cream and hope for the best. It means start your research where you already have an advantage in your daily life. If you're a nurse, you see which medical devices hospitals can't stop ordering. If you're a teacher, you know what software schools are switching to. If you're a contractor, you see which materials are selling out every month. That's information, real, valuable, early information. And it's right in front of you. You don't have to outsmart the market. You just have to outweight it. Wall Street's attention span is measured in weeks. Yours can be measured in years. And that simple difference gives you the edge. Most professionals are forced to act even when the best thing to do is nothing. They have to justify their fees. They have to show activity. That's why so many funds underperform the market. They're too busy looking busy. Meanwhile, the patient individual quietly holds a handful of solid companies, reinvests dividends, ignores the noise, and wins. Here's the beauty of being small. You can move freely. If a fund manager wants to buy a company, he needs to move millions of dollars. He can't sneak in or out quietly. His trades move the price. You can buy a few hundred shares without anyone noticing. You can get in early, before the headlines, before the crowd. That flexibility is power. You can be nimble where the big guys are clumsy. You can be selective where they have to diversify. And you can hold through volatility because you don't have a boss timing your every move. Now, let's be clear. Having an edge doesn't mean you don't need discipline. You do. You still have to research, understand the business, and have the guts to hold through downturns. The market will test you. It'll make you doubt yourself. You'll hear experts saying you're crazy for holding a stock that's fallen 20%. But if your conviction is built on real knowledge, not hope, not hype, then time will reward you. Because no algorithm, no economist, no high-frequency trader can compete with someone who actually understands the company they own. People forget that investing isn't about IQ points. It's about temperament. It's about controlling your emotions when everyone else loses theirs. The amateurs who succeed aren't the ones who guess right about inflation. They're the ones who can sit still through chaos. They know what they own, why they own it, and they don't need anyone's approval to keep owning it. That's how ordinary people beat Wall Street, not by being smarter, but by being calmer. Not by being faster, but by being steadier. If you take nothing else from me, take this. You already have what it takes to succeed. You have the access, you live in the real world. You have the advantage, you can be patient. And you have the freedom, you answer to no one but yourself. Wall Street is filled with people trying to look brilliant for one quarter. You can afford to be quietly right for 10 years. In the long run, that's what wins. Not predictions, not sophistication, just observation, discipline, and time. So stop trying to act like Wall Street. Be smarter than Wall Street by being simpler than Wall Street. Because in this game, the tortoise doesn't just beat the hare. He compounds. When people talk about my career, they usually mention the numbers. 29% annual returns for 13 years. Turning $100,000 into nearly $2.7 million. They call that legendary. But honestly, that's not the legacy I care about. Numbers fade. Markets change. What lasts is the lesson behind them that ordinary people using ordinary logic can achieve extraordinary results. That's the real story. Not Peter Lynch, the fund manager, but Peter Lynch, the believer in common sense. When I started, I wasn't trying to become famous. I wasn't even trying to become rich. I just loved the puzzle of business, the simple question, why do some companies win while others disappear? It fascinated me because behind every stock chart, every percentage point, there's a story about human behavior, customers, workers, managers, and investors all playing their part. And if you could understand that story, not the noise, not the news, but the story, you could see the future, at least the part that mattered. That's what investing really is. It's storytelling with math at the end. I've seen so many investors waste decades chasing the illusion of control. They think if they just read one more forecast, subscribe to one more research letter, or analyze one more data set, they'll finally predict the market. They won't. Nobody will. The market is a mirror of humanity, greedy, fearful, hopeful, irrational. You can't predict it. You can only participate in it intelligently. And that's what common sense is all about. It's the rare ability to stay sane when the crowd loses its mind. To look at a business and ask the simplest question of all, is it making money? Because if the answer is yes, and if it keeps making more year after year, then the price will eventually catch up. Maybe not next month, maybe not next year, but eventually, always. I've been asked many times, what's the hardest part about investing? It's not finding ideas. It's staying rational when the world isn't. When your stock drops 20%, the headlines scream, market panic. And everyone around you is selling, that's when investing becomes psychological warfare. Not against the market, but against yourself. You'll feel fear whispering, get out before it gets worse. And greed whispering, buy everything. This is the bottom. Both voices are wrong. The right voice, the one that rarely gets heard, says, relax, know what you own. If you truly understand your companies, that voice will keep you grounded when everyone else is drowning in emotion. That's why knowledge beats noise. Every time. I never believed in being a market genius. I believed in being a market student. I learned from failure. I learned from boredom. I learned from watching ordinary companies do extraordinary things simply because they had good products, honest management, and loyal customers. That's why I always told people, investing is simple, but it's not easy. It's simple because the principles are timeless. It's not easy because human nature isn't. Greed, fear, envy, they never go away. They just change costumes every decade. In the 1970s, it was gold. In the 80s, it was conglomerates. In the 90s, it was dot-coms. In the 2020s, it's something else. The details change, but the stupidity stays the same. You can't beat human nature, but you can learn to manage yours. That's what long-term investing teaches. Patience, humility, and self-control. It's a mirror for your temperament. And if you stare into it long enough, you'll learn more about yourself than about the market. Because the market is the world's most honest teacher. It doesn't care who you are, what you studied, or how confident you sound. It only rewards discipline and punishes delusion. That's why I love it. It's ruthless but fair. If there's one message I hope outlives me, it's this. You don't need to predict the future to get rich. You just need to understand the present better than most. Buy what makes sense. Hold it long enough. Ignore the rest. You don't have to find 100 great stocks. Just a few good ones and the patience to sit on them. That's the magic. That's how fortunes are built. Quietly, slowly, rationally. People call my approach the common sense method. I call it growing up because it's what mature investors do. They stop chasing excitement and start pursuing endurance. They stop trying to look clever and start trying to stay consistent. And when you finally make that shift, the market stops being a mystery and starts being a machine that works for you, not against you. You don't need to shout at it. You just need to understand it. And that, my friend, is the real freedom of investing when your money starts working harder than you do. One day, when people look back at my career, I don't want them to say, he beat the market. I want them to say, he proved that regular people could too. Because that's the truth. The edge was never on Wall Street. It was always in your backyard, in your everyday life, your patience, your observation, your calm. The professionals can have their models and forecasts. You keep your common sense, and you'll do just fine. In the long run, the stock market isn't a game of genius. It's a test of character. It doesn't reward brilliance. It rewards behavior. If you can think clearly, act patiently, and stay rational when everyone else is losing their mind, you've already won. Because in the end, common sense always does what it's done for me and for every successful investor who ever lived. It wins.